Hey everyone, hope you're doing well. This is the deep dive. My name is Drew Creekmer. I'm the Director of Advisory Services here at Creekmer Wealth. And I'm joined as always by John Creekmer, our founder and Senior Wealth Advisor. And John, today we're going to talk some current events. There's
Mm,
been some movement, some pretty drastic movement in the stock market recently. So we want to put some context around that and just talk through some really important key data points that we've seen. And John, you've been doing this now for we're on our 30th anniversary here at Creekmore Wealth, so multiple decades, and you've lived through great markets like the one we've had for the last couple of years and some rough times in the market. And from your standpoint, what's one of the key learnings you've had over the last 30 years or so?
I'll tell you what the first one is when someone says just like you did, Drew, how experienced I am, you're simply just saying that I'm old. And so that's the first thing that I've learned. Um, but it comes with the territory. So the thing that's great is that I just love working in the industry. I've seen so many things mentioned over the years. I mean, it's so interesting. In 1998, we saw the Russian ruble collapse, and then in 2000 we had the tech bubble that just kind of blew things up, went to 3 negative years in a row in 2021, 22, and lived through the lost decade of 2010, the collapse, the Great Recession of 2008 to 2010, phenomenal time. We saw COVID in 2020, and then this huge sell-off in which bonds and stocks were correlated. In 2022, we're down 19% and 16%. And, seen a lot of things, Drew, and everything really boils down to a plan. It also boils down to understanding how things are going. Oftentimes, you listen to the media, you listen to what's going on, and it's like, man, there's so much bad information out there that people tend to react emotionally without much logic to it. And recently, Drew, we've seen a lot of things turning and a lot of stuff under the surface that's saying, be careful, be aware. And then I see more, whenever I see those things, I see people pile on and invest more and more money in the equity markets. And it's like you're setting yourself up for a big loss. So
Yeah.
Drew, the biggie is to be aware of what's happening around you and, have a plan how you're gonna execute through it.
For sure. For sure. And John, on that point, a number of deep dives over the last few months, we've talked at great length about some of the things we're seeing underneath the surface that led to us to say, hey, now is not the time to be super
Mhm,
aggressive in
mhm.
equity markets.
Yep.
Now is more the time to have a plan, be a little bit more protected, which we've done on behalf of all of our clients, which has been very beneficial over the last month or so. But I want to put some more data around just where we are at this moment in time. We're going to have a chart up on the screen here that's going to walk through the current Schiller PE ratio of US equity markets. And what PE stands for, that's price to earnings ratio. So the price of the equity or the stocks in the S&P 500 versus the earnings that they are producing. And historically, if you see very low PE ratios, that means there's a lot of growth potential that could happen. Where we stand today is we are actually at the second highest PE ratio in US history. Now, this chart goes all the way back to the early 1900s, only exceeded by that dot com bubble, John, that you referenced. And so, anytime you see a PE ratio this high, what that really means is that companies are overvalued. And one simple piece of alarming news can cause a quick and rapid sell off. Which earlier this week, we got some news from a AI company in China called DeepSeek that announced that they were able to train their AI learning module at a significantly lower price than what their US competitors are paying. And what's fueled this run over the last few years has been a lot of excitement and growth potential around the AI sector. That's been very beneficial for a lot of you folks who are watching this video and made some great gains from participating in that run. But this news was unexpected. And the way a lot of folks are viewing this is if this Chinese company is actually able to train their model at that low of a cost, then US tech companies are at a significant disadvantage. Now, that said, there's a lot of unreported information that we're seeing come out. So there's some more nuance to that significantly lower
Mm.
cost that this Chinese company is not reporting. But that news did trigger a big sell off in the broad based indices and in a number of individual stocks that a lot of you all own. So, John, when you think about just this moment in time in the market, what are your thoughts about having a plan and how to view this unexpected event?
Andrew, what you just said there, that's the key to the whole thing. And so whenever we get a highly appreciated market where it gets way past the norm of what's strong value, and David, Warren Buffett says the surest way to make money is not to lose it. And I mean, the reality is when stuff gets too highly priced, you gotta be careful how much you're paying for it. If you pay $100 for something, you can turn around and sell it for 50. That's not a good deal. And when you look at what happened, I mean, Drew, we see the chart there as far as in the Schiller PE, it explains it greatly. Folks, look back at that chart. Man, oh man, back in 1929 was the first time we had that huge parabolic increase. We had the Great Depression after that. So then you look back at 2000, Drew, man, oh man, we saw that it got to the highest level as far as the PE ratio in the history, had this huge parabolic increase. And then all of a sudden we had negative rates of return in 2000, 2001, and 2002. And again, some of that was accentuated by by the terrorist attack on September 11th of '01, but nonetheless went to a great recession. And then the third one that we see this parabolic increase we're living in currently. And that's the second highest level of PE ratio in the history. And all of a sudden, one little blip of news comes out about this new seek engine driven by AI over in China that we don't know any news on, that we have no facts on, that is just put out there what could be. And all of a sudden, the market drops off. Nvidia drops 14% as far as in one day, as low as 17% at one point. Other key leaders that are also highly valued all had a huge pullback. And so it's one of these things, folks, you need to be careful when you're investing and how you're investing and having a plan, not just to get into, but also how do you get out of the market. And that's why we started raising some capital, going back to the middle point of last year, is that there's a lot of things that are indicating this market is overly valued. We really foresee a pullback coming on the S&P 500, potentially down to first run for sure at 5,600. We got down to 59, hit close to 5,600 back there in the fall, August, September timeframe. But we see another pullback coming to that leg. If a couple things line up, it could go lower than that. We just want to, and again, keep in mind, folks, we are perma bulls. That means we believe the market does move up, but we believe the short-term times where it does come back, you just want to be careful in the short-term times you don't hurt yourself.
Yeah, absolutely. And John, that's where having that plan is key. Our investment committee for really the last 9 months has been preparing proactively for a moment like this and making sure we have a plan in place, which is why I mentioned at the top of the video, over the last few months, us taking gains out of the market and protecting those has been very beneficial for you all. To John's point, we always want to sell high and buy low. Easier said than done. But that's where our analysts have done a great job with some of the tools we built out to help us identify when's a good time to sell and when's a good time to buy. And so, John, let's kind of go practical here. I want to put up another chart and just talk about the forward looking plan that we have. This chart actually shows the valuation of the US stock market versus its European peers. And as a number of you are familiar with from talking with your advisor, we really don't have anything allocated to international markets at this point. We've pulled back from that in large part because of just poor performance of those companies overseas, and also with the incoming administration, some concerns around tariffs. But when we look at this chart, John, we talk about valuation being important. What do you think about investing in international markets? Is that something we're going to consider in the months ahead, or are we going to wait and see how everything plays out?
We have this huge thing of tariffs out there, and I think the one thing we want to keep in mind, folks, is that there's a lot of times the current administration, President Trump, has been known through his business career and also through his first term in office as being a very good, adept negotiator. And so he always goes out there with a big stick early on and holds that out there, uses it as a negotiation tool. So we're not sure exactly where the tariffs are going to land, but we do know that it's a threat out there. So you do have to be careful that once you head down a tariff path, it could lead to a huge tariff and trade war, and that would not be good for anybody. However, I believe that he will use the opportunity to actually to get some stronger positions for the U.S. economy and U.S. workforce. That being said, when we look at valuations, there is a tremendous opportunities internationally. We have not been invested internationally for quite some time, as far as the large allocation, even though most models would indicate you should hold somewhere between 15 and 35% of your portfolio in international. It's been a tremendous laggard for the last 20 years. And so we've totally avoided that area. But we're now starting to see such this huge divergence between valuations in the US versus valuations internationally. Both the FTSE and the stocks are so significantly lower. They're in the low teens as far as in valuation metrics, that we see tremendous opportunities. Now, Drew, when we do go in, we're probably going to be looking more country specific based upon what their demographic trends are in their industries. We'll also be looking company specific within those countries to find those that have a wide moat and that have a strong leadership presence. And so, that being said, folks, you may start to see some sprinkling in of some international names, really depending upon what happens, a little bit of the trade tariffs. but also what happens with interest rates. And so as we see U.S. interest rates, they've kind of leveled off. We're seeing the 10-year Treasury a little bit over 4.5. If that would have an approach to 5% number, we'll probably look into exit a little bit more aggressively out of the US and look a bit more internationally.
Yep, absolutely. I think that's a great summary of what we're thinking about. And John, I know you mentioned the dot-com bubble earlier on, but during that particular decade, international markets did perform better, right, than U.S. stocks. And so the trend that's worked well for the last 10, 20 years, there's a possibility it might revert. And so that's why we're looking for other opportunities selectively in different markets. And so, guys, just to wrap all of this up, we anticipate the next number of months in markets has the potential to be quite volatile, like we saw earlier this week. That's due in large part to the current overvaluation of the US based market, but also some things like interest rates or tariffs that we know are out there that could lead to additional volatility. And this is why having a plan is such of critical importance for you all. And John, what would you say folks should do right now if they're just thinking through where the markets are at as it relates to their bigger retirement income goals? What's a good action item for folks to take on that front to make sure they're squared away and have a plan in place?
Yeah, for sure. If you work with criminal wealth advisors, and some of the listeners here do not, and some a lot do, but if you do, make sure that you get connected with your advisor and have a discussion just about when it is you're planning on needing to access the funds and what your risk tolerance is and what your risk level in your portfolio is to make sure there's proper alignment. And that being said, Drew, we do have a number of tools that we use that really decrease risk but still give you some strong upside potential. We have a couple more coming down the pipeline as far as non-correlated assets we'll be rolling out here in the next quarter, as far as just different asset classes that I'm very excited about. And so talk with your advisor. They know all about that, but you want to make sure your risk is properly aligned. And folks, if you do not currently work with your wealth advisors, I would encourage you to reach out, set up a phone call, and actually walk through the risk in your accounts. Drew, we have been getting a lot of folks recently that have been watching the deep dive and watching other things that have seen me on national television that are wanting to have us actually do a huge X-ray on their portfolios just to share within the level of risk. I would say reach out, have us do that for you. We get you information, help you make better decisions.
Yeah, absolutely. I think that's a great action. I'm everyone. So either respond to this email if you don't work with us currently, and our team will be in touch. Otherwise, if you're a client of ours, please reach out to our office. Our advisors are all briefed on the current environment we're in and know the best tools to help you guys stay on track to achieving your big goals that you all have. And we all love working alongside you to help you achieve those. So, guys, thanks for the time. Look forward to talking to you all soon. And we'll see you next time.